Good morning, everyone. How are you doing today? This is part B or part dos of kind of a what if future scenario. Part A, or the first one, was just completed. It was kind of the rosy picture, if you will. What happens if the 30-year interest rate goes from 3% to 1.5%? What happens if the federal government comes out with a first-time home buyer tax credit? Kind of walk through that, what impact it would have on our business. What would I do today? Well, this is the reverse. Instead of assuming interest rates are going from 3 to 1.5, we are going the reverse. What happens if the 30-year mortgage rate goes from 3 to 6%? And then in addition to that, instead of giving a tax credit, we are going to go, what happens if the federal government comes out and removes accelerated depreciation, cost segregation, things that real estate investors count on? This is, again, like the first one, possible but not probable. But again, when I look at my business, I am trying to make decisions today that I will feel good about in the years to come. My crystal ball is as good or as bad as yours. But I'm trying to make decisions with tens, if not hundreds of thousands of dollars. So these are important what-if scenarios to play with. So the first one, what if interest rates go from 3 to 6%? And again, that is interest rate on 30-year mortgage, the fixed rate. So the first thing that happens, if for whatever reason the 30-year goes from 3 to 6%, is real estate values will fall. Real estate, as I've said many times, is really a payment investment. And if you are going to double the interest rate, you can count, you can plan for price erosion, value erosion. There will be markets that are today affordable when you calculate at 3%, that will be wildly unaffordable at 6%. I follow the affordability index. It is published in California by the California Association of Realtors monthly. You can go and look at it. It's got 30 or 40-year history. The affordability index is important because it basically equates average payment and average incomes and how much the average person can afford. And trust me, if you take interest rates from 3 to 6%, affordability is going to take a massive hit. Massive. And the end result of that will be price erosion. So what does that mean for our portfolio? Well, first and foremost, our net worth is going to take a hit, and probably a massive hit. The good thing is if you follow this channel, you will know that I recommend getting 30-year fixed rate debt. So my properties should still cash flow, as renters will go up because buyers will shrink, because my debt is fixed. The beauty of single family residential property ownership is that 30-year fixed rate debt. Here is the truth. If interest rates go from 3 to 6%, commercial, multifamily property will take a hit. Commercial property, unlike residential, usually has 3, 5, 7, in some case 10-year terms, amortized over 25 or 30 years, which means you are forced to refi. These are some of the subtle differences that these average investors don't talk about. So for me, one rental at a time, one residential rental at a time, I will be okay. We will be okay. You follow this channel, you do what we talk about, you will be okay because you have 30-year fixed rate debt that even if the value of the house is cut in half, the bank will not call the note. Residential properties don't work that way. Commercial properties, you can quickly get into default. You can quickly have to raise cash because now your debt service is all out of whack because the interest rate is now 6 instead of 3. It can get really, really painful in the commercial market. think 5 units and above. All right, so that's one story. My net worth sucks, but my cash flow probably goes up because there will be less buyers and more renters. Number 2, what happens if the government comes out and removes, cancels, deletes accelerated depreciation and cost segregation? These are both legal and approved ways to use your tax return to reduce your income tax owed. Again, if we talk about one rental at a time versus the overall real estate market, you, the single family owner, will not be greatly impacted. First and foremost, single family owners, to my knowledge, I don't know of any single family investor that does cost segregation. There is typically a break-even point because it is costly to do that usually I've read comes into play at 50 units and above. Even if it's 20 units and above, it still means the residential investor will not be impacted at all if cost segregation is removed, deleted, stopped, unapproved, whatever. Accelerated depreciation, this will have some impact on residential investors. You put on a new roof, you put in new windows, major mechanicals. You know, in the current world, you can take all of that as year one expenses. Go back to historical averages where some of those are 7 years, 30 years, whatever. There will be some impact at the residential level, but again, the largest, greatest, and most impactful area will be in the commercial market. The larger investors are counting on accelerated depreciation and cost segregation in their models. It is planned for years in advance, and to lose those two things would be detrimental. So in the end, if the 30-year mortgage rate explodes, by explode, I mean doubles, it goes from 3 to 6, I believe it will have meaningful impact on the commercial multifamily, meaning 5 units and above, just because of the rate structure changes. If you are following my model for 30-year fixed in residential, your payments will not be impacted. You will not lose the house just because the value fell. And in fact, your cash flow may rise. When this happened to us historically, we actually saw more qualified renters because they couldn't afford to buy. As affordability collapses, again, going from 3 to 6% would cause that, we would see better renters, higher quality renters, and more demand. So yes, cash flow will likely rise as demand, meaning more renters, come. Yes, you won't be able to tell your friends you're worth as much, but that's not a number to talk about anyway. So in the end, there are my A and B, my 1 and 2 scenarios. What happens if rates go down? What happens if rates go up? What happens if tax credits? What happens if they remove tax credits? So this is all interesting stuff. These are all things I think about. I am looking to make investments that are supposed to exist for my lifetime. No less than 10 years into the future. So these are questions I ask myself all the time. So let me know what you think. Again, part A was if interest rates went down and a tax credit came out. Part 2, which I'm completing now, is what happens if rates went up and they removed or canceled tax incentives. All right, everybody, have a wonderful day. Take care. Bye-bye.